All right. Welcome back. We are in the next module, entity selection part 2. Picking your legal entity. We're going to talk about corporations, S corps, and LLCs. Let's get into it. So, disclaimer here: this training is informational only. It does not constitute legal or professional advice. You are encouraged to consult with a licensed tax professional, enrolled agent, or CPA if you have specific questions related to any of the topics covered in this presentation. Now that we got that out of the way, let's get into it. Corporations. So, what is a corporation? So, a C corporation is a corporate entity, either U.S. or non-U.S. A U.S. corporation is organized in a single state, although the corporation may do businesses in many states. All right. Ownership of a corporation is in the form of stock. There is no limit to the number of shareholders that can own a single corporation. C corporation. In addition, there is no limit on the number of classes of stocks that can be issued. A corporation comes into being when its organizers file articles of incorporation with the state or country in the case of a foreign corporation. And that's really all it is, guys. I know a lot of times, even myself, before I even got into this stuff, I used to think a corporation was this big, huge entity. You had to have millions of dollars. You had to have meet all these crazy requirements. No, it's literally that's all it is. It has nothing to do necessarily with size or money or anything like that. It is just a filing and the way that you file your business with the government. All right. So, liability protection, obviously with a corporation, as you can imagine, it is a separate entity, and you do not have to worry about any liabilities or as far as being liable with your personal assets. So you have protection there. So it's an awesome way to protect yourself and have that protection. C corporations, they own assets and are liable for its debts. Shareholders are not liable for corporate debts. So if you own stock in a company, you'll realize that you do not have to pay off the debt that the company owes. So just want you to think about that. As we start talking about corporations, just think about yourself. Just kind of make the distinction between you as a shareholder and the company as the company. The fact that shareholders are not liable for corporate debt is one of the primary advantages of the corporation as a form of a business. Transfer of income to shareholders. So shareholders who provide services to a C corporation are treated as either employees or independent contractors, depending on specific circumstances, and are taxable on the compensation received. When shareholders are employees of a C corporation, they are eligible to receive tax-free fringe benefits such as health care. They can also participate in a company-sponsored retirement plan. So, taxation of the C corporation. So the C corporation is taxable on the income it earns. Shareholders of a C corporation are not directly taxed on this income. A C corporation is the only business form where this is the case. So all other business forms are pass-through entities where owners are taxed directly on the entity level income. So very important distinction there. Although shareholders are not taxed directly on the corporation income, they can be indirectly taxable, or they can be taxed indirectly. If a C corporation distributes the income in the form of dividends, then shareholders have to pay taxes. So that is the only time that shareholders have to pay taxes, when those dividends are paid out. But not if when you begin to sell the stock of the company too. So estate planning. The corporate C corporation is a useful device for minimizing the estate and gift tax in general. Stock in a C corporation is often valued for the estate and gift tax purposes at a discount to the value of assets owned by the corporation. The C corporation is a useful device for minimizing estate and gift tax, and in general, like I said, is often valued at a discount. So an S corporation, what is an S corporation? So an S corporation is a U.S. corporation that elects to be taxed as an S corporation. A U.S. corporation is organized in a single state, although the corporations may do business in many states. Ownership of the corporation is in the form of stock, and it's the key distinction here. An S corporation can have no more than 100 shareholders, okay, and can only have one class of stock. In addition, eligible shareholders include only individuals, certain estates, certain trusts, and certain other S corporations. S corporation comes into being when its organizers file articles of incorporation with the state, and an S corporation is created by filing an S corporation election with the IRS, the Internal Revenue Service. Liability protection, same thing as a C corporation, so not much to say there. You are protected. Taxation, so it's going to be a separate entity, right? So like I said, you and the business are taxed separately, and you're going to get what's called a 1120 S, which is the tax form for S corporations. The corporation is going to use a 1120. The S corporation is going to use 1120 S. And with some exceptions, an S corporation is not taxable on the income it earns. So in certain states, the S corporation will actually have to pay minimum tax and franchise tax. So just keep that in the back of your mind. Taxation of shareholders. So like it says here, shareholders of an S corporation are taxed on the corporate level income. Shareholders are taxable on the corporate level income regardless of whether that income is distributed to shareholders in the form of cash. And essentially all that is that you get taxed for your share of the profit. So for example, let's say that there are 4 shareholders in a company, and the company's profits are 10,000. Okay, each shareholder will have to owe 2,500, which will appear on a form that is called a K1. So if you ever heard of the K1, that's what the K1 is. It's just showing you you're part of the profit. So is it pass through or a separate entity? As I mentioned, it will operate as a separate entity, but you need to vet it out too, just to make sure. Depending on, you have options with it essentially, so you just want to make sure that you are choosing the right option based on your unique circumstance. As far as owner's compensation, so you are a shareholder in the corporation. The ways you get paid out, either through distributions or wages, as I mentioned, and fringe benefits. Also the same thing with the C corp, right? So very similar to C corp. LLC, very, very popular, and this is actually one of the newer entities. Very, very popular, and probably maybe a good idea for you. So a limited liability company is a hybrid entity that's treated like a corporation for limited liability purposes, but for tax purposes, you can choose to either be taxed as a corporation, partnership, disregarded entity, which is a single member LLC. And an LLC is treated under state law by registering under a state LLC statute. Like corporate shareholders, LLC members are not personally liable for the obligations of the LLC. Instead, their liability is limited to their financial investment in the enterprise. Unlike a limited partnership where general partners remain liable for partnership debt, all members of a LLC have limited liability. So disregarded entity, as you can see here where it says single member LLC, they file what is called a Schedule C, and it has to be registered with the Secretary of State, and you need articles of organization instead of articles of incorporation. So that's one of the key differences between the LLCs and the corporations. And in the LLC, you are considered a member, okay? So you're not a partner, but a member of the LLC. For an LLC that chooses to be taxed as a partnership, the tax rules are the same as those of general partnerships, except for minor differences. Similarly, an LLC that elects to be taxed as a corporation will be taxed in the same way as a corporation. So you can be taxed as a corporation. If that's the case, like I said, you will have to file what is called 1120 instead of a 1065. Partnership, same rules, but minor differences, or a disregarded entity. So tax and non-tax differences in various business forms. And then you have what we have here. So as I mentioned, as being part of an LLC, you are considered a member. LLC also provides its owners with limited liability. Unlike a corporation, a limited liability company in general partnership does not afford its owners limited personal liability. So this is the key thing here with the limited liability. So it's kind of like the best of both worlds, where you can get that pass-through income, but then also you have the liability protection. That's why it's so popular. And the owners are personally liable for the partnership debts and for the acts of the fellow owners performed in furtherance of partnership businesses. General partners and the limited partnership have the same type of personal liability as they do in counterparts in general partnership. However, the liability of the limited partners who do not manage the business is limited to the extent of their respective investment in the enterprise. So, as we can see here, with the LLC, you have it as pass-through, as I mentioned before. Owner's comp, you have the draws as well for the LLCs. Fringe benefits, very similar to the sole proprietor. So you get some fringe benefits if you have W-2, but not really. And that concludes this section for the legal entity. So I hope you enjoyed it. Again, a lot of information I know that I went through, but I want to go through it quickly just so you get at least get an idea. Again, if you have questions, feel free to reach out to me. It's going to be at contact@michelvalbrun.com, but I just want to introduce this concept to you. If you guys want to dive in deeper, you can. But again, just be aware with it so you are an astute and smart business owner. So alrighty, I hope you enjoyed it. Take care. Later. Bye.